Words. I mean, certainly we have improved. I mean, over the last year, and a lot of that hard work has come and paid dividends. We have built on our improved our operations, our deployment of the vessels. That's given us some cash generation and additional profitability, which wasn't there before. So we've managed to push through those efficiencies. Now that leaves us with more scope to assess the right way forward. We're very much reviewing our strategic options, and we can do so from the perspective of being compliant with our bank loans, which is a situation that is now basically came through to us at the end of last year when we were compliant with our loan-to-value covenant, which had been an issue for a while. And so thanks to the improved performance, thanks to the strength of the markets, we've been able to get there. And now we can, as I say, review those options that we have in front of us going forward with more cash in the bank and from a better leverage position. We certainly have the ambition not to stand still. We still have work to do internally, and I think we've been quite consistent in our messaging there. We want to sort out the portfolio that we have, and then certainly the idea would be to grow and to develop the fleet that we can along selected sectors as we move forward. But I think the key thing is to make sure that we focus on the right type of deals, that we ensure that we mitigate residual risk, that we pick the right sectors, we pick the right counterparties, and we try and make sure that any growth is managed in the right way, and we do so on a very measured basis. We have two container ships which are on long-term bareboat charter, which get redelivered in January 2016 from Evergreen. And I think the point that we make there is that obviously they are quite a significant revenue contributor. Fortunately, at the moment, we're making great strides to replacing that revenue from the fleet we already have. We recently signed a 2-year deal on one of our Aframax tankers at a significantly higher rate than the market had been paying, certainly last year when we fixed the last one. We have some other product tankers this year that come back, which we expect to see some improvements on versus the last rates. So we'll be looking to make up incrementally those revenues. But certainly we don't want to be in a position where the trust just contracts. So going forward, we will be looking at ways to replace revenue, to renew the fleet, and to grow. The process at the moment is to review those options and to look at what strategy we can undertake and the timing of that. And so all of those things are uncertain. But we're certainly working towards looking at how we can develop the trust going forward. What we've always said, without being cliched about it, is that we're reasonably sector agnostic. So we're looking at the key things that I mentioned before. We're looking at partnerships in the right sectors, so key clients, preferably probably end users or strong operators in the sectors that we work with, and looking to try and put together, I guess, projects that work both from a return perspective and deliver accretive results to our unit holders, and that are being placed at the right point in the cycle where we're not just building lots and lots of residual risk. So not looking at trying to invest in very hot sectors at the moment. Well, that would be. I mean, we certainly see that the tanker market, thankfully, has been doing quite well. We don't think necessarily that improvement is likely to stop anytime soon, but we're also very aware that it's easy to fall into the trap of investing while a market is looking hot, rather than trying to get involved before you see that improvement. I mean, and certainly what we'd be looking at doing now is balancing the need for cash flow deals, because we obviously are looking to start a distribution again and be a yielding stock, balancing that off against the residual risk that occurs if you start taking cash flow deals at the top of the market, which is effectively the situation we were in before, where very high asset prices were paid for deals with good cash flow, but when those deals subsequently fell apart, that leaves quite a big hole, which we've spent a long time trying to fill. So now the idea is to make sure that we learn from those lessons, and we make sure that we enter the market at the right kind of time. I think it depends on who you ask. I mean, I think if you're talking to someone who is looking at it from a purely value perspective, then certainly pricing at the moment is as sharp as it's been for a long time. And you can just see by the interest that's on the second-hand market sales at the moment, the amount of people that are inspecting ships that are being put up for sale. People are clamoring over assets that have become available because they feel we're at the bottom of the market. Does that make sense for the trust? Not without cash flow. And I still see that at the moment the dry bulk market probably has some way to recover before we start seeing it feed into rates. And we're not really in a position to go out and invest on a purely value kind of play where we expect that value to rise over time, because we need to be able to service a distribution, so we need cash flow that goes along with it. So, given that, it's not a sector that we've invested an awful lot of time and energy into at this point, because the parameters of the deal that we could put together don't quite tie up to our investment criteria. But it's certainly a market that we watch with interest. We're dealing with lots of different subsectors of the market there. The product tankers that we have coming back, some are small and specialised, so kind of 4,000 to 12,000 deadweight. And so, given that, the market dynamics around those are very different from, say, the sizes that are a bit larger. The MRs that we have coming back from time charter this year, that market is remaining pretty firm on the spot side at the moment. Freight rates are good. We expect to be able to deploy those vessels in a way that hopefully improves in terms of the rate that we're currently earning. And then if we look at the larger tonnage, which is likely to come back in further term away, so kind of 2017 and beyond, the LR2s, that market is also looking interesting. I mean, the rates remain firm. The only issue is probably on both the MRs and the LR2s is oversupply. We think that the order book obviously looks a little bit challenging, particularly on the MRs. But that's why we've taken contract coverage before. That's why we look to again try and do that and ride out the wave of new ships coming in. And we see that particularly on the LR2s in 2016. Unfortunately, that's a period for us that's covered. So while we are very aware of the risk factors around redeliveries, our focus is very much looking at the ones that are clear and present and that we need to deal with, and those are the MRs for the time being on the product side, and also working closely with the partners we already have. On the smaller side, James Fisher has been a very good and supportive client of ours, and we continue to talk to them about what to do in the future with the ships that we have on charter to them. So we feel we're focused in the right areas, that the markets that those ships are in remain interesting, and certainly we're quite happy to be exposed to tanker tonnage at the moment and tanker markets, having seen how well they've performed over the last 6 to 12 months. So, I mean, certainly the first thing that we were trying to achieve, and we've managed to achieve, is compliance with our original loan terms. I think we need to, walk before we can run. We've managed to consolidate the balance sheet. We've got some cash now, and the overall financial position of the trust is much more secure. We need to, ensure that we don't overextend ourselves again and get ourselves into a position which is difficult to defend. And in terms of the way in which the trust has grown in the past is through issuance and through doing deals where they make sense, and financing that through a mixture of both new equity and debt. I can't imagine we won't review and look at that as a strategy to use going forward. And more recently, we've actually decided that it makes more sense to buy back our units, and we've been doing that recently because we feel they're inherently undervalued, and we feel that there is further to go with the story of the trust, and that we think very much from a value perspective it's an accretive thing for us to do to our unit holders, to buy units while they remain at a low price relative to our asset value, relative to the value of the contracts that we have at the moment, and relative to the cash balances. And mainly the combination of all of those things. So although issuance is something that we will look at the moment, the focus has actually been on looking at accretive buybacks, which is not exactly the inverse, but certainly thinking that that one of the best ways we can deliver value to the unit holders is to buy our own units at an undervalued price. Necessarily different. I mean, I think the way in which people invest in a counter-cyclical way is just taking advantage of cheap pricing. I mean, and normally that is at the cost of people who are not doing so well. So basically, you end up in a situation, be it funded by family businesses or private equity, it doesn't really matter. The investment will be made when asset prices are cheap and when people are feeling the pain. So I don't think that having private equity there to finance deals in a counter-cyclical way saves the poor or underperforming companies. The thing that saves them is the reluctance of banks to take haircuts and to really liquidate positions, because that obviously is difficult from their perspective as well. And what we've seen is to some degree there are banks that are doing that now, more and more so, but certainly in the past that problem's been pushed along for a long time, and companies have been allowed to exist where there is very little equity in play, and where the debt on the ships is far in excess of the market value of those ships. So that certainly I don't think we can blame private equity for, and we can't blame counter-cyclical investors for there being companies that haven't kind of fallen over. In fact, it's more the people that are giving those companies lifelines at different points in time, and we have to be quite careful what we say in that position, because FSL was under pressure. I think the key thing is that we've learned from that is that sometimes the best way forward is to have a close relationship with the people providing finance to you, and to work with them and to show that you can improve performance dramatically, that you can make operational efficiencies work throughout the organisation, and that does end up driving not just improved commercial performance, but certainly financial performance and asset quality. I mean, and overall it means that the condition of the ships that they're financing is that much better as well. Which is a bit of a digression, but I mean, certainly I wouldn't lay any blame at the door of counter-cyclical investors for companies not being or not being allowed to die, if you like. I mean, the drivers of that kind of process are very, very different.